highs for the NASDAQ on Friday. So the question becomes, do investors need some sort of an exit strategy? Let's get Lachlan Hughes from Swell Asset Management to give us his thoughts. Lachlan, welcome to the program. Yeah, does it all come down to your expectations for interest rates, essentially, for US 10-year Treasury yields?
For us, it doesn't, Nadine. But as you say, it's a good point. So we're entering a low growth world, and that low growth world is a function of the demographics, which is we have an aging population across the developed world, but we've also got a lot of debt that's built up over the last few years. So this means that we're going to be in a low growth world for some time. So we really have to find the types of companies that can grow irrespective of the macroeconomic backdrop. So I think it's still a good time, but it's very much a stock picker's market now, and the easy money's been made.
So where are you looking then if it's a stock picker's market? Are you still gravitating toward the big quality names in terms of US tech?
Yeah, absolutely. Big tech has a wonderful decade ahead of itself. So yeah, we're still very positive on big tech, and we're also looking at unique opportunities outside of that space.
Like what?
Okay, so at the moment, one of our biggest positions is a stock called Zillow. Zillow is the realestate.com of the US, and they have a very strong listings business. They have the largest website in the US for listing residential homes. But they're also getting into a new market, which is called iBuying, which is an instant buying, which allows a vendor to sell their property within 7 days. And we see this as a huge opportunity. In the US, real estate agents take about 6%. There's a 3% for a buying agent and 3% for a selling agent. And with those costs removed, and also given the fact that Zillow has a database with 135 million homes, using those two features, they'll be able to offer, liquidity to investors or vendors who would like to exit the market. So we see that as a very strong area of growth for Zillow, and something that is in only a nascent stage in the US.
Is there not big competition in that space in the US?
There is competition, but it's such a new market, Nadine. So their biggest competitor is a business called Opendoor, and they acquired around 5,000 homes in the last quarter. But iBuying at the moment only represents less than 0.1% of all homes transacted in the US. And we really see that getting to 10% over the next 5 years. So a huge opportunity, and competition doesn't tend to bite until the market matures. And there is a lot of growth for Redfin and Opendoor and Zillow. We believe that Zillow has the strongest moat, and that's why we've chosen to invest with them. But we see it being like a buoyant environment for all of these iBuying businesses.
Yeah, and I guess the reality is the US market is just so huge, and there's a lot of challenge going on in relation to the big banks there, just as we're seeing here in Australia. I'd like to get your thoughts on PayPal. We've been talking about them a lot here because of the competitive landscape, in particular in terms of buy now, pay later in the US. We also got word last week that PayPal might be looking to muscle its way into the online broking space. What do you think about PayPal?
We love PayPal. It's one of our core holdings. And their growth has come. I guess originally it started out as a payments platform for people who want to transact online. But as that's grown, they're moving into different areas. And buy now, pay later is one of the areas they're moving into. Trading is another. But we saw last week Square, or the week before, Square acquiring Afterpay, and I think that's showing everyone how big buy now, pay later can become. It's only a very small percentage of e-commerce payments, and this could easily reach 10, 15, 20% of total online payments over the next decade. And PayPal is very much part of the buy now, pay later growth. They're saying that it's the strongest product they've had in the history of PayPal. So, we still think it's a great business for its e-commerce payments platform, but we also think the buy now, pay later represents a huge opportunity for them.
So would you hedge your bets by owning PayPal and Square or Afterpay, or have you you're backing PayPal essentially to be a winner?
Yeah, look, that's a great question. I would love to own Square as well as PayPal. We have not been able to get there on the valuation, and it's one we probably kick amongst the team every sort of 3 to 4 months and have a look at the new opportunities it's moving into and trying to price those opportunities. We think there is a huge opportunity for Square over the next decade, and we think the Afterpay acquisition was a fantastic acquisition. Unfortunately, with value investors, we can't get there on the valuation, but PayPal we can. So it's one that PayPal we've held since it separated from eBay in 2015, and we'll hold that for the next 5 to 10 years. And you mentioned earlier about them moving into broking. I think you're going to see all of these financial or fintech businesses start to take business away from the large banks. They moved into payments. You've seen them now shift into credit card receivables with their buy now, pay later business, and loans is a natural extension that they'll move into. So I think as positive as the environment is for the fintechs, I think it doesn't bode well for the traditional banks.
Now, you did mention that you're value investors. I had a conversation earlier this hour with a gentleman who is saying that there's real value emerging in Chinese and Hong Kong listed companies. Do you see that in Chinese tech?
Do you know, Nadine, we do. We really see opportunities in Chinese tech. But one of the I guess, things we've struggled with is, and we have owned Alibaba and Tencent in the past, but one of the things we're struggling with at the moment is the regulatory environment in China. It's definitely shifted. The government has really changed their view on big tech, and I guess they're bringing in a little bit more ideology into their decisions around big tech. Previously, they were focused on their core technologies, and Chinese tech was really a fantastic assistance to the Chinese government through the COVID period by issuing vouchers and really fostering economic growth. But one of the things we're always looking at is the economic moat and the economic moat around each company. And despite Alibaba and Tencent having really deep and wide economic moats, the issue they have is those moats are built on, I guess, a very unstable foundation. And we believe that unstable foundation is the approach that the Chinese government's having towards these businesses. So for us at the moment, given we're focused on capital preservation, we won't be going back into the Chinese companies anytime soon. But I do think for, I guess, a more nimble or perhaps a shorter term investor, that those stocks do represent good value in the short term.
Well, Lachlan, thank you. We covered a lot of ground. Really appreciate your insights today.
Thank you, Nadine.